Hello and welcome back to my channel. In my last video, which you can find here, I talked through the differences between ETFs, index funds, and mutual funds. And a lot of you asked me the same question. Which ETFs do I actually buy? So today, I'm going to answer that question, and I'll list the 5 ETFs that every Canadian investor should at least know about. I mean, you should know about these ones. I'll explain what they are, what they cost, and why they should be on your list. But before we start, I want you to know that I'm not a licensed financial advisor, and nothing here is personalized financial advice. These are 5 well-regarded ETFs that are worth researching for your own goals and investment timeline. And one more thing, every ETF on this list has one thing in common, which is low fees. In my last video, I showed that a 2% fee versus a 0.2% fee on the same $10,000 over 30 years creates a $31,000 gap. So nothing on this list costs more than 0.25% per year, so you'll be saving money on fees. Now, let's get into it. So the first on this list is VEQT or XEQT. I'm grouping these two together because they are almost identical in every way that matters. So they have the same low fee structure, same global diversification, same passive approach, and they both hold stocks across Canada, the US, and the international markets. And they returned 20.45% in 2025. That's a real deal. Now, the real differences are minor. So VEQT holds a slightly higher percentage of Canadian stocks, while XEQT pays out its dividends every 3 months instead of every year. Now, you can call this a one-ticket fund where you buy one, and your entire portfolio is set for global diversification and automatic rebalancing. So this ETF is perfect for a beginner who just wants to start and not overthink their ETF choices. XEQT or VEQT is a very straightforward choice on this list. Now, moving on to number 2, we have VFV, which is the Vanguard S&P 500 ETF. If there's one index that the whole investing world is watching, it's the S&P 500. So if you're wondering what that means, it is the 500 largest companies in the US stock market, and it includes companies like Amazon, Apple, Microsoft, and a whole lot more. Over the last decade, it has been one of the best performing stock market indices on the planet. So I really like VFV because it trades in Canadian dollars on the Toronto Stock Exchange. So you don't need to open a US brokerage account or deal with currency conversion. You simply buy your VFV the same way you would buy any other Canadian ETF. And the best part is it pays dividends quarterly, and it is the low-cost ETF, which is available to Canadian investors anywhere you go. One thing to be aware of is VFV is 100% US stocks. So you're not getting Canadian companies, you're not getting European companies, or even international companies. So you can pair VFV with XIU, which is the next ETF on this list. Now, XIU is iShares S&P TSX 60 Index ETF. Okay, that was a mouthful, and I really needed to get that out, and I get it correctly. Now, an interesting thing about XIU is it is the original Canadian ETF, which has been around since 1990, and it is one of the oldest ETFs in the world. So you can imagine how far back this has gone. Now, when you hold a single unit of XIU, it means you're simply buying into the backbone of the Canadian economy, where you buy into the big 6 banks, you have major energy producers, railways, telecoms, and even insurers. And the good thing about XIU is it tracks 60 largest companies on the Toronto Stock Exchange. It's kind of similar to the S&P 500. On its own, XIU is fully Canadian, so it doesn't have the global diversification that you find in a VEQT or XEQT. But if you pair it with something like VFV for the US exposure, what you get is a very clean, low-cost 2 ETF portfolio that covers both sides of North America. And it also pays dividend quarterly, which is every 3 months, and is very popular with income-focused investors who want to see something landing in their account every quarter. So in the 4th place, we have VBAL, which is the Vanguard Balanced ETF portfolio. So not everyone can handle seeing their portfolio drop 30% during a bad stretch in the market, and that's completely valid. I totally understand it. VBAL is built for exactly that person. So it holds 60% of global equities and 40% of Canadian bonds, and it offers a much more smoother ride than your all-equity ETFs, even during market downturns. However, it has a lower long-term growth ceiling, but it also has significantly reduced volatility, and is also another good one-ticket solution. Now, the all-equity ETFs like VEQT and VFV, they are very aggressive and they have high growth potential, but very, very wild swings. An ETF like VBAL reduces those swings by mixing in like 40% of bonds, and you get a long-term upside in exchange for a much, much calmer ride through market turbulence. So you should consider this if you're closer to retirement, or if you have monies that you would lose in the next 5 to 10 years, or if you're that kind of person who doesn't like to panic when the markets drop. But my advice is a portfolio that you stick with is better than an aggressive portfolio that you ditch halfway. So just choose one ETF and roll with it. And in number 5 spot, we have VDY, which is Vanguard FTSE Canadian High Dividend Yield Index ETF. Now, this is for people who want their portfolio to generate regular income, not just grow quietly in the background. And it focuses on Canadian companies that consistently pay out high dividends. So these are your banks, your utilities, and your telecoms companies. These companies regularly pay a portion of their profits as dividends, which is good. And because you're getting them through an ETF, rather through buying individual stocks, your risk is spread across multiple companies instead of just holding one stock in your portfolio. So VDY is a Canadian-based ETF, so it doesn't give you the US exposure as well. So you can use this in combination to other US-based ETF. So which one should you actually buy? Well, here's the honest answer. It depends on where you're starting from and what you want your money to do for you. If you answer those two things, you can then choose the ETF that's meant for you. If you want one ETF that covers everything, buy either VEQT or XEQT. If you want maximum US market exposure, buy VFV. If you want Canadian exposure, buy XIU. If you want to remain calm and a stable portfolio, buy VBAL. And if you want dividends, buy VDY. You can buy all of these ETFs through a self-directed account on either Wealthsimple or Questrade, and you can even hold them in your TFSA, RRSP, or FHSA, or even in your non-registered account. So there's no single best ETF actually. The right one that's for you is the one that you would actually buy and hold and keep contributing even when your mind and your instincts are telling you to sell. The most powerful thing you can do right now is just simply start. Just buy one ETF inside a brokerage account, make regular contributions, and just hold it for the long term. That's where you can tap into these benefits. If this video has helped you in any way, let me know in the comments, like and subscribe for more content, and I'll see you on the next one.